Well, I don't want to draw too many broad conclusions and stereotypes. There's always great entrepreneurs that I think can come from anywhere. And in fact, we have invested in, great entrepreneurs in many places outside the US. Probably the one thing that I would say is pretty different is just pace. And so in Silicon Valley, there's a pretty crazy amount of talent and there's a pretty crazy pace that you don't see even in other parts of the US. The one place I would say that's maybe an exception is probably China. My few visits in China, I would say at least in Beijing and possibly in Shenzhen and Shanghai as well. There was a crazy pace, and some might even say more intense pace in China than in the US. But most other places around the world, there wasn't as many startups and they weren't moving as quickly.
Dave, how are you?
Okay, how are you doing, Barack?
It is a pleasure to see you. Practical VC. Is it practical, by the way?
That's the name, but actually venture capital is far from practical, so that's the joke.
Do you see the Silicon Valley is losing its dominance for startups?
You're back, baby. I would say it's a mixed bag. Probably we've been through probably the toughest period over the last 2 years, and it's nice that we both have dogs here. I don't live in the city. I live a little bit further south, closer to Stanford, and situations here are fine. It really hasn't changed very much. My part of the area is a little bit sleepier. That's where all the other VCs and probably semi-retired entrepreneurs live, people with families. San Francisco, I guess certainly it's gone through some tough times, both from a city governance perspective and from an investment perspective. I guess the good news is it seems like we're coming back, probably at least because of the AI companies. There's a ton of AI companies up in the city that have been getting a lot of funding and a lot of attention. And another friend of mine, Jeremiah Aoyang, I don't know if you know Jeremiah, but he's been organizing a lot of AI-focused events in the city, and those have been incredibly, well attended, thousands of people. There's still a lot of issues with the city in terms of, probably more crime than we would like that doesn't go punished, and homeless problem and probably a drug use problem. And over the last, I guess 4 or 5 years, that had been getting worse, and probably there was people in government there who weren't really addressing the problems. That seems like that's changing. And so I don't know if you followed it recently, Gary Tan and a bunch of other people who are more involved, who live in the city and were involved, have tried to get a more progressive set of candidates in office. It looks like that's actually happening. And so I do expect that we'll probably see better changes in the future, but it's still a long way to go. And the overall backdrop has definitely been that, a lot of venture capital has pulled back over the last 2 years for, more obvious reasons, with market conditions being tough. Valuations are down. Amount of capital being deployed is down, again, with the exception being AI companies. So it's been a pretty tough period of time. In some ways, it maybe feels similar to previous downturns in 2008 and 9, and maybe even more like 2000, 2001. Not a lot of folks in Silicon Valley were here for some of those previous downturns. So it's kind of the first time for a lot of people going through a downturn. But for some of us who've been here for 25, 30 years, we've seen the movie before, although, slightly different things that are happening now. So I would still say it's going to be a tough year ahead, maybe even a tough 2 years ahead. But I do think things are probably heading, back in a positive direction. We'll see how the IPO market shakes out here over the next 6 to 12 months. I guess Reddit is trading this morning, so that's probably, one indicator. A few other IPOs I think will happen before the end of the year. We should see some more. And maybe if the Fed makes a few more rate cuts by the end of the year, we might see a little bit recovery there.
Tough year for whom? Entrepreneurs or investors?
I think both. Well, the curious thing is, that a lot of companies raised a lot of money, particularly in 2020 and 21. And so many of those companies, even after the downturn happened, they still had a lot of cash. I would say 3 years ago, they had 3-4 years worth of cash. This year, because they've stretched it out and they've tried to turn around their prospects, a lot of companies are now running out of cash and have maybe less than 12 to 18 months. So I think now we're in a situation where many companies are going to have to make decisions. They're either going to have to raise down rounds or they're going to have to get acquired or shut down. A few companies who are doing well enough to IPO will probably try it. And so I think we will see, there's definitely a number of pent up IPOs, and some of those companies are doing quite well, although valuations might be cut in half from where they were. If you look at some of the recent IPOs that have gone out, Reddit is, I think, being priced at $6.5 billion. That's down 35% from their peak price. Two other companies that I think are doing extremely well, Stripe and Canva. I've been small investors in both of those as well as Reddit. They're both down by about 35%, and those are some of the best companies. I think, it's a mixed world where there are, companies that are now doing well, but across the board valuations are down. And then there are other companies that are not doing so well that I think are going to have to face the music. And probably in the next, 6, 12, 18 months, we'll see a lot of those companies either have to sell or shut down or do down rounds that really change their valuations. And so both for entrepreneurs and for investors, I think we're going to see a pretty, difficult environment for the existing portfolio companies. For new portfolio companies, I think there's a fair amount of capital available at early stages. Again, valuations might be down a little bit, and overall capital deployment is down a good bit, but there's still a lot of companies, getting capital. Certainly in many areas, deep tech, climate tech, life sciences, genetics, even in more traditional areas like e-commerce and SaaS, there's still quite a bit of startup activity going on, but it is a tougher market than it was 2 or 3 years ago, and that's not surprising. I think the time frame of 2021 was really the irrational period. I think we're kind of back to some kind of normal that might have been, maybe between 2016, 17 timeframe, at least in terms of, pace and valuation.
How did you invest Canva?
Well, we made a very early bet, pretty much 12 years ago. I think it was 2012 or 13. We had gotten to know some other investors in Australia, so we were LPs in Blackbird, which is run by Rick Baker and Nikki Skabak. Nikki and I had met back when he was in California, even further back than that. But there was a small group of investors that were putting money in around that time. I think Bill Ty was one of the notable folks also. So we wrote a small check. It was just a $100,000 check, I think, at roughly an 8 million cap, which funny enough at the time I thought was a little bit expensive, but fortunately I still decided to do the deal. I think at the time they were really a small team of maybe 5 to 10 people. And I met Mel and Clint in Sydney, I think in 2013, fall of 2013. Actually, we had even made the investment before that. So that was pretty early. My big mistake was that we didn't ever follow on that check. We should have put money in some of the follow-on rounds, but still, that $100,000 check today is worth close to $200 million. It's kind of crazy. Almost a 2000x multiple on that. I'm not realized yet, so I should, hold off before we, start making any assessments. But still, even a great company like Canva, I think they're probably doing over 2 billion in revenue. They're profitable. They're growing, probably 40, 50%. Even they have had, a little bit of a pullback in value.
While you were doing this Canva investment, did you use the pray and spray method or power law?
Well, regardless of how you describe it, we were certainly doing a large number of investments. I think at the time, we were probably doing 200 or more investments per year. In some years there, maybe even 300 or 400. But we probably were averaging, I guess, around 250 companies a year for those first 7 or 8 years. So if you look at the first 3 funds at 500 Startups, which is now called 500 Global, we deployed that between 2010, middle of 2010, and through maybe end of 2016, 17. So roughly 7 years and about 1,800 companies. So about 250 companies a year. So we were doing a lot of investments. I would say, some people use a pejorative description for that. But we believed, obviously, from the name of the company, 500 Startups, was based on very large portfolios and diversification. And what we kind of found, if you look at those portfolios 10, 12, 14 years later, we really, were able to get IPO outcomes, or at least large unicorn billion-dollar size outcomes, about 2 to 3% of the time. So roughly 2 to 3 companies out of 100 would get to, a $1 billion, potential outcome, or even larger. Those were probably 50 to 100x wins. Maybe in some cases they were even more than that, like Canva. And so most of our, returns, most of our economics were coming from really just those top 2 to 3% of companies. Other people had more concentrated portfolios. More typically, people would do 30 or 40 companies per portfolio. And, I don't know if the numbers were dramatically different, but probably, I would say mostly single digit percentages of those companies that would get to an IPO. And so some people were smart or lucky and they would get, one big win, maybe even more than one, but probably most people would get zero big wins. And so our philosophy was that, well, we'd like to have more shots on goal and have a better chance at getting those bigger outcomes. And so we saw.
How did you develop your this playbook? I think concentrated portfolios was hot, not broad number of
It wasn't
startups.
just hot. It wasn't just hot. That was just the accepted methodology. Large portfolios were very unusual at the time. I think probably initially Ron Conway and SV Angel had started pioneering some of those ideas in the late 90s. First round capital was doing at least, maybe 75 to 100 companies per portfolio. So those two folks were maybe the earliest people doing larger portfolios. But we probably took that to another level when we started. Certainly, as the name implies, we wanted to do large portfolios. From my previous angel investing experiences and from my work investing at Founders Fund, I had just seen, kind of the numbers. I probably made maybe 15 investments personally and another 20, actually probably closer to 30 or 40 when I was at Founders Fund. So I'd probably done about 50 investments, prior to 2010 when we started 500. And we did have some big wins out of that. I think Twilio and Credit Karma and Lyft and a few others, but it was still a minority of our, investments that did very well. And so I had come from a mathematics background and I just generally felt like, well, we're only seeing, so many of these companies move from, seed stage to Series A and from A to B. And so I was really thinking, we needed minimum 100 companies, but probably more like 200 or 300 companies per portfolio to have some, I guess I would say, statistically predictable chance of success. And it turns out that was pretty much on target. I think we took a lot of heat and a lot of criticism at the time for people saying that was a really crazy strategy. In hindsight, now it looks like that was a very logical and reasonable strategy. And other groups, Y Combinator, Techstars, even Sequoia, who is doing it through their Scout programs, and AngelList. There's a lot of data now that indicates large portfolios really can work quite well. Although it still does matter what the entry point of valuation is. And so, we were fortunate that probably most of our investments were made roughly at valuations, less than $5 million. So for our accelerator companies, probably between $1 to $2 million. For our seed stage companies, probably between $4 to $6 million. And this was, obviously 10 years ago. Things have changed a little bit.
Were you ever hesitant about this broad portfolio approach? And did you have to convince your LPs that it will work? Did you ever experience imposter syndrome while telling this new strategy?
I probably had imposter syndrome every morning and every evening. So I was always scared shitless that I was wrong. But at the same time, I think we had built the entire strategy for the fund. Obviously, we named the company 500 Startups. We didn't call it 50 startups. We didn't call it 5 startups. We called it 500 startups. But I do remember, people used to laugh when I said that name. Like they would literally laugh in my face when I said the name 500 Startups. And fundraising was very difficult. I think we probably had 3 different strategies that were just different from everyone else. One was the large portfolios. 2 was investing globally. We did a huge number of investments outside the US. We probably had people in 20 countries. We invested in over 75 countries. And so that was very unusual, certainly at the time. And then the third approach was just that we were doing a lot of different things. So we were running an accelerator program. We were running seed stage programs. We were doing conferences and events. I used to run a travel group called Geeks on a Plane, which is now called 42 Geeks. And we also started a bunch of micro VC funds under the 500 umbrella. So we started about 20 small funds, mostly regional vehicles in different countries, but a few other verticals. And a bunch of those people have gone on to become successful VCs outside 500 as well. But certainly the large portfolio and the global approach probably made it very difficult for us to raise capital. Those were not considered to be great ideas. And even the accelerator approach, which I think a lot of people now look at as being pretty, reasonable, at least, as a standard part of the industry, it wasn't viewed very favorably at the time. Even Y Combinator, as late as 2010 or 11, a lot of people still had questions about their strategy. Obviously, that changed quite a bit with the successes of Dropbox and a few other companies that went public. So because we were very different, most of our fundraising was pretty difficult. And, we were not getting traditional investors and traditional institutional investors. We mostly got a lot of small checks from friends that we worked with at, PayPal and Facebook and Google. We got some very, great support. We had initially some support from Founders Fund, Redpoint, Excel, and Blue Run, and also some individuals like Mark Andreessen and Brad Feld and Mitch Kapoor and Fred Wilson. So we did have a great group of investors, but a lot of small checks.
How did you make a unique position compared to other accelerators?
Yeah, we started about 4 or 5 years, probably 5 years after Y Combinator, about 4 years after Techstars. There were other accelerator programs, but there weren't thousands. There was definitely YC and Techstars in Europe that was Seed Camp. I think in the US, a few others like AngelPad, but they were still getting started. And so we didn't have tons of people to compete with, but we did have to compete with Techstars and YC, which had already started, 4 years, 5 years before us, and were already pretty well known. And so it was, again, challenging. Part of what we really were trying to do was differentiate ourselves with a couple of things. One was really on the global approach. The other was on, trying to help people with different strategies like design and user experience and maybe marketing and growth. So probably in those initial days, I would say YC was viewed as a very engineering-centric, tech-centric accelerator, which obviously had done a terrific job. We invested in a bunch of YC companies as well. We were probably emphasizing marketing and growth as one of the differentiators and the global approach as another differentiator. But even at that time, we had been accelerating a lot more companies. So we were doing hundreds of companies per year. I think at the time, YC was probably still only doing 20 companies a batch. I think we were differentiated on a lot of different areas.
Do we need new acceleration programs? What is the value of accelerator programs add to the startups?
Well, I think it's not just the education part, which I agree with you is available online. And, a lot of people don't choose to go through accelerator programs. But still, there was a pretty strong community aspect of what we were doing. We were an in-person program, so we would typically have 30 to 40 companies per batch in both Mountain View and San Francisco, and then later in other parts of the world, in Mexico City and Middle East and Southeast Asia. So for us, the community of people who were starting companies, being around other startup founders created a culture that I think was, geared towards building and building quickly. And a lot of the knowledge that you could read individually wasn't quite the same as the experience you'd have being around other founders and in person. So I do think that's one part of it. There's some sort of critical mass element to community when you have, 50 to 100 people who are all working on startups together. People don't take as much time off when everybody else around them is working hard. People are encouraged to, continue to work hard. And kind of what we found was, we would typically have at least 30 companies. The top 10 to 20% of those companies would tend to be outperformers. So usually we would see 3, 4, 5 companies that would really be doing well, working hard, and their behavior would, encourage others to model that same behavior. Those top 3, 4, 5 companies would compete with each other for progress and just, bragging rights. And so we found that having those tight communities of people really encouraged a culture of entrepreneurship that was probably higher level of quality, faster pace than they might accomplish by themselves. Now, that might not be true for everyone, and I'm sure for some entrepreneurs who are, self-motivated, they don't necessarily need to have other people around them to compete. Those top 2 or 3 companies probably would have been successful, anyway. But they probably were competing harder because there were other people around them who were also great. And they also probably encouraged that next group of students, I use the word students, but entrepreneurs that might have only, had okay companies compete at a higher level and figure out a few strategies, faster. So we felt like that, that community and camaraderie, that culture was really important, at least when companies were getting started in their first year. And that helped a lot. Also, it didn't hurt that we were running that program in Silicon Valley, and we had a lot of advisors and mentors who had worked at other startups, myself at PayPal, other folks at Google. Christina's been at Google for many years. So we were in an environment where it was relatively easy to get other startup entrepreneurs, other angel investors, other VCs who were very close by to drop in and give advice and give talks. And that really helped with the companies moving faster and also raising capital.
What about today? Should you start, for example, acceleration program, or should anyone start acceleration program? Do you advise them?
I still think it's a good path. It's not necessarily for everyone, but at the same time, I think probably more focused programs that are specific to a vertical or specific to a stage of company are probably helpful. I think it's probably difficult at this time to start a completely new accelerator program that is, competing broadly on different categories. There are a few people that can do that, but, given where the established, accelerator programs already are, it's probably difficult to break in unless you focus on a particular area. So I think there are programs that are focused on, climate tech or AI, maybe life sciences or genetics that can be very helpful. I think it's still helpful to have, programs when people are getting started, going from concept to prototype or from prototype, to sort of, functional product. Those are pretty difficult stages for people that haven't done it before. And I would still say for those folks, being around other people who have done it before can be quite helpful to figure out those paths. But it's not going to be for everyone, and there are certainly a lot of tools and services and other things that are advantages now that can be done, virtually and remotely from almost anywhere.
You have worked entrepreneurs globally. What are some biggest cultural differences you have observed between founders in the regions outside of Silicon Valley versus within the other startup ecosystems?
Well, I don't want to draw too many broad conclusions and stereotypes. There's always great entrepreneurs that I think can come from anywhere. And in fact, we have invested in, great entrepreneurs in many places outside the US. Probably the one thing that I would say is pretty different is just pace. And so in Silicon Valley, there's a pretty crazy amount of talent and there's a pretty crazy pace that you don't see even in other parts of the US. The one place I would say that's maybe an exception is probably China. My few visits in China, I would say at least in, Beijing and possibly in Shenzhen and Shanghai as well. There was a crazy pace, and some might even say more intense pace in China than in the US. But most other places around the world, there wasn't as many startups and they weren't moving as quickly. On the investor side, I would also say there's a really big difference in most places, and that includes China as well, at least in the beginning. Most of those investors were not familiar with investing in startups and how, startup investment worked. And a lot of people would blame, the entrepreneurial side of the equation for why there wasn't as much, success in certain geographies. I always used to point out that it was usually more on the investor side than the entrepreneur side, but it was a number of factors. So, concentration of talent, concentration of experience, concentration of capital, those things were pretty special in Silicon Valley. They've really developed here over the past, 75 years. A lot of entrepreneurship started even, before the 1960s and 70s, after World War II and the Korean War, a lot of the initial investment was happening out of military spending, and also happened, when Stanford and Shockley Semiconductor got started in the 50s, and later Fairchild and Intel. So that period of, rapid innovation acceleration started happening in Silicon Valley in the 50s and 60s, and then a large number of investors started getting established in the 70s and 80s. There were some changes in something called the Prudent Man Rule in the US that allowed mutual funds to invest in VCs. Even before that, there were some programs that were created by the Small Business Administration to invest in venture firms. So in the 60s and the 70s, those changes legally happened and capital started really scaling up. Sequoia and Kleiner happened, I think, in the late 70s, but a lot of those VC firms got started in the 70s. And then you saw further acceleration happen in the 80s and 90s. So it's hard to sort of say, in other countries, well, hey, they're not doing that great. Well, they've only been at it maybe 10 or 20 years, whereas in the US and particularly in Silicon Valley, they've been at it for 60 or 70 years. And so you have multiple generations of entrepreneurs, multiple generations of investors. You have very large, companies here in the Valley. Literally for decades, they've been multiple different companies. And you have some great institutions here as well, Stanford and Berkeley and others. So I do think we're starting to see those patterns happen in other parts of the world now. Particularly, I think you're seeing in certain places, India and China, just from large population perspective, have had pretty substantial success. Certain places like Singapore and Dubai, I think there's a lot of smart programs for how venture capital can get off the ground. In London and Tokyo and a few other places as well, there's been some reasonable success. And then I think you found that there are, certain countries where there's a really strong technical talent base. Turkey is certainly one of them, where there's a large number of entrepreneurs and talent that are coming to the table. Even, sometimes there isn't as much capital available, but certainly a pretty significant amount of talent.
I know that you are investing in secondaries right now, but let's go back to 500 VC days, fund days, and also today. What is your decision-making framework while investing right now and earlier?
Right. Yeah, well, it's pretty different. I think when we were doing early stage investment, our thesis was, well, we know that only a small percentage of companies will be successful at large scale. And so we were going to make a large number of investments per fund. We would look for some amount of success. And so that might be that they've been able to build a product, that they've gotten a certain number of users or customers, they're generating some amount of revenue and hopefully, in the future profits, but probably not much profit at the time. Even many companies, they might not already be at revenue, but we were looking for at least 2 or 3 areas of success that they'd been able to figure out. So you're not looking for perfection. You're looking for ability to survive and iterate and make progress. And so we would look at maybe, I would say 5 or 6 different categories: product, markets, revenue, growth, team. And if, it looked like it was interesting on at least 2 or 3 of those 5 or 6 factors, we would say, okay, great. It looks like you're making some progress. Let's write a small check and see how it goes. And we knew that, most of those companies probably wouldn't make it, but maybe a third to a half would make it to the next stage, and maybe half of those would get to the next stage. And so we were sort of thinking in our heads that maybe 5 to 10% of these companies could get to some interesting level of, potential outcome where that might be 10x or better on our returns. If we looked at what we're doing now, it's much more later stage investment. We buy secondary positions either in funds or companies. And I would say more, we do that at the fund level. And I can explain a little bit why. But if we're looking at companies, we're typically looking companies that are already at Series B or C stages of investment, probably 50 to 100 million in revenue. And part of our, thesis here is we'd like to see an exit in the next 3 to 5 years. And so if we think about in the US IPO market today, probably $300 or $400 million worth of revenue is typically what we would expect to see at a minimum for companies that are going public. We probably want to see that they're already getting close to 100 million in revenue to have a shot, within a few years of growth. And so that's a very different profile of company. Most of those companies are already, at some size or scale, maybe a couple hundred people. They probably have, established line of business. They probably have hopefully some profits or at least some positive unit economics. And they have a amount of growth that, we'd hope to see at 50 to 100% or more per year, and that has an ability to sustain itself. So, we're not looking at potential wins. We're looking at things that are already successful and growing. We still know we'll have some percentage that don't continue to grow or don't get to an exit. But hopefully in this case, it's more like, 50% of them will get to an exit, maybe more than 50%, and hopefully at least a third to half of them will get to an IPO. And again, within a 3 to 5 year period. If we're buying fund positions, then we're looking at funds that are at least 5 years old, maybe even 7 to 10 years old. Probably those funds have 1 or more winners that we think are headed to an IPO. And kind of what we know from experience is that some number of the investors don't want to have to wait, 12 to 15 years to see exits. They may not have realized how long it was going to take when they first invested in those funds. But what we've seen is, at least for the non-institutional investors, for the earlier stage, smaller funds, there's usually some number of investors who are looking for an exit early in that 5 to 10 year period. And particularly right now in the current market, That's certainly the case where there hasn't been very many exits for the last 2 or 3 years, and a lot of people are looking for liquidity. So, now we're looking not so much as potential, but like sort of already established businesses, established, profits and growth. And we have a pretty, tight filter where we want to see exits within a, 3 to 5 year period of time. So it's quite different than what we used to do. But a lot of the intuition that we have now is from watching those portfolios over the last 10 to 15 years and seeing thousands of companies. I guess I should say thousands of companies, but most of them not making it, and maybe 50 of those, 1,000 to 2,000 companies that did make it to an IPO.
How does intuition play a role today's decision and also earlier ones?
I don't think today's decisions are much based on intuition. Today's decisions are based on numbers, metrics. I guess, well, in some cases where we don't have perfect access to information, we have to make some informed decisions. We still expect to see a good bit of data, but we probably look at a portfolio size now that's only 20 to 30 investments, whether those are companies or funds, whereas before we used to look at 200 to 300. So, we're coming in much later in a stage of company, probably 5 to 7 years later than we would normally. And we're also cutting the portfolio size down by, an order of magnitude, really, from, a couple hundred to maybe just 20 or 30. So it is different in that we don't really rely on intuition. And even when we were doing 500, it wasn't like we were relying on intuition, but there was less data to look at. Here, there's a lot of data to look at.
Should you tell us about the practical VC secondaries? Why now?
Why now? Well, I think, for a lot of this, I was trying to solve problems where I actually had the same experiences. I was, I'll explain a little bit. Originally, when we were starting, we were thinking about doing a fund of funds to invest in micro VCs and to do education and provide a platform for people. And I still think that's a great idea. And there are other people who are now doing that. You're probably familiar with Adea Resi and VC Lab Decile Group. We're investors in their company. There's another group called Coolwater Capital that does a little bit smaller curated approach, and we're investors there as well. But what I found 4 years ago, I had been looking for some liquidity in my carry in my first two funds at 500. Those funds had gone very well. We were investors in Twilio and Credit Karma and Lyft and others. We were investors in Canva and others. And so back about 4 years ago, I was looking to, get some money out of that to buy a house in Silicon Valley and start the new firm. And I thought I would have a very easy time in finding buyers for those carried interest, or at least a portion of it. And it turned out I was wrong. It was a bit challenging. It took me a while to find the right buyer. I was able to take a good bit of capital off the table, and I was able to buy a house here in Silicon Valley. My wife and kids were very happy about that. We put about 4 or 5 million into the new company to get started. I've even put some money aside, for the kids for college and into a family foundation to do some other, philanthropic stuff. But, I ended up selling, my positions at about a 30% discount. I had to, guarantee, some multiple of returns for those investors. And so really, I kind of thought, wow, these guys are getting a pretty good deal. I think maybe this is an interesting opportunity for us to look at. And that was where we really started shifting our focus into secondaries and particularly fund secondary, which I would say is a little different than investing just in company secondary. But I can even maybe show you, there's a picture that we tend to show people. I can share this. And so I'm kind of showing you a picture of how a venture fund progresses over maybe a 10, 12, 15-year period. Again, this might be a normal fund that starts with 30 or 40 companies at seed stage. Maybe, let's say a third to half of those get to Series A. So maybe it might be 10 to 15 companies at Series A. And maybe, 5 to 7 companies get to Series B. And then by the time we're talking about Series C or later, it's probably just 3 to 5 companies that are getting to those levels. And that might take 5 or 6 years, right? And so in the beginning, you have a lot of bets. Probably most of them aren't going to work. They're still very small early stage companies. But around year 5, 6, 7, you'll start to see, hopefully for the portfolios that are actually doing well, you'll see 1 or 2 or 3 breakout companies that, get to Series B or C, get 10, 20, 50 million in revenue, get to maybe 10, 20x their initial size. And so you start having portfolios that are a little bit more concentrated and hopefully growing, pretty fast. And so what really happens, at least, for the top third, 20, 30% of these portfolios, where they do have winners, those winners start to take over the growth rate of the portfolio around year 6, 7, 8. And, as we were talking about power laws, the closer you get to the end of the fund, the more it looks like just one company ends up being the big winner. And in this example, you'll see in that last circle on the top right, where that one Series D company is starting to take over and become most of the portfolio value. And so we had noticed this in our own portfolios in 500, particularly in Fund 1 and 2 and 3. And we realized that those would have been great portfolios to buy around year 6, 7. Like before year 5, 6, 7, they maybe were doing okay, but they didn't look that great. But after year 6, 7, things really started to take off, and those portfolios did very well, mainly because they had one or two big winners that were really still growing fast and becoming the main drivers for those portfolios. And so what we realized was, hey, if we could just cut those portfolios in half and buy positions in those funds around year 7, plus or minus, we would be able to get a really great investment. And beyond just being a great investment, it would also happen a lot faster than a typical fund. So we kind of say, this idea of skip the J curve, that's that first 5-year period where the returns are maybe flat or down or depressed, and then catch that period where the companies are starting to really, grow fast and grow quickly. And because we are cutting it in half and buying the back half, we'd have a much faster time to liquidity. In our, estimates, we're generally seeing a 1x return of capital within just, 4 or 5 years, and hopefully more like a 2 to 4x return in 7 years. And, 2 to 4x for the fund might not sound that amazing, but if you can do that quickly, the return IRR is still pretty good. And that's a lot different than a traditional fund where you might only see 0.5x come back in the first 7 to 10 years. And, maybe if you're lucky, things go well, you might see 2x, in 10 to 12 years, and potentially, more down the road. But we emphasize a strategy where we're not taking as much risk, we're not taking as much time. We're all kind of already betting on something that's working, and we're getting in, at a fairly substantial discount to value. We're buying fund positions at a minimum of 30 to 50% discounts, and in this market, really more like 50 to 70% discounts. But in addition to the discounts, we're buying into growth that's already established, and we're buying into an exit that probably isn't much more than 3 to 5 years. So that's kind of the basic ideas.
How do you see the secondaries market evolving in upcoming years? Is this the first fund that secondary funds already running?
We've raised and deployed 2 funds already. We're working on our 3rd fund now. So the first funds were 20 million and 56 million. Those funds have done pretty well. The first fund's already up more than 2x net. We've already distributed about 30 cents on the dollar out of that first fund. The second fund, we're just finishing deployment out of, but that's also gone pretty well. We're up about 20% in our initial investments there. And now we're working on raising a 3rd fund. Hopefully that'll be a $100 million fund. Generally, same strategy. I think we feel pretty confident that there's a big opportunity in secondaries right now in venture, particularly at the fund level. There's other people that do company secondary investing, platforms and brokers, but not as many people that are doing LP and GP interests at the fund level. And we think that's going to be a big category, already is a pretty big category. But right now, not very much competition for those assets, at least at the check size that we're going after.
How do you evaluate the funds?
Well, I think we would say we already have quite a bit of business that's coming our way, so it's not something we're really concerned about. Again, maybe I'll just show you a little bit of how we think about evaluating. So when we look at funds, I guess really quickly, I'll just show the difference between company secondary and fund secondary. So company secondary, you're looking at one company. You're buying positions, equity from either existing investors in the company or possibly from founders or employees in the company. And, you still have to get access to information. Sometimes that information is not, perfectly transparent, but you're looking at one company, one balance sheet, one set of financials When you're looking at fund secondary or what's called a strip sale, you're buying a slice of the overall portfolio, and you're buying a piece, either from the limited partners who are investors in the fund or from the general partners who are running the fund. You're buying a slice of all of those companies. And so when we look at how to evaluate that, we put them into sort of three categories, the underlying companies in a fund. We look at the companies we think are going to be unicorns or already are unicorns. We look at the companies that might not be IPOs, but still might have a reasonable chance of an exit. Those are typically companies that are at least doing 20 million in revenue and up. And then there's a whole bunch of companies that could get to an exit, but maybe it's not probable. These companies are generally doing less than 10 to 20 million in revenue. They may not have raised that much capital, or they may have stopped growing, or they may not be profitable. So it's really those first two categories that we look at to value the assets. We're really anchoring on that first category. Hopefully the unicorn and IPO companies are more than 50% of the portfolio. We still do a bottom-up analysis to figure out what we think those major company drivers are worth. And it might be just one or two companies. It might be maybe 3 to 4 companies. It's not usually much more than that in most portfolios. And then we look at that second category, and this is where, it's not as definite that there'll be an IPO, but there's probably some kind of exit. And then the third category is really one where we write those down for the most part to zero, I would say, or at least a much lower percentage of value in the portfolio. But we're really looking at that first category to anchor, what we think will be big wins and exits and growth. The second category maybe is another 20, 30% of the value. That third category, we typically will discount pretty heavily. And then we try and add up the parts. And then we talk to the sellers and try and negotiate a price and a structure that, they're willing to accept. Sometimes we buy at a very specific, all upfront, all one price discount. Sometimes we'll do a structure where we might ask for additional coverage or ask for an upfront and conditional component. It might look like an escrow or earnout component. So there's, an upfront payment and then a later payment. And then we try and underwrite to a multiple that's, typically a 3 to 5x return on our investment. That won't happen all the time, but that's usually what we're looking for. Usually a 3 to 5x return in 3 to 5 years. And, it might end up only being 2 to 3x, but still, if we do that quickly, that's a pretty good IRR for us.
So
but like I said, a lot different than looking at early stage portfolios. We're really trying to look at things that are already valuable and growing.
Do you acquire the whole fund or partially of the fund?
Buying all of the fund. In fact, most of the time we're buying relatively small pieces of a fund. So not usually more than 5 to 10%. Our typical checks are in the 1 to 5 million range. And, we want to buy portfolios that we think are doing well and growing, even if they might be a little bit lower value than where they're priced. We're still bullish on the underlying assets. So sometimes it's a conversation with the limited partner. Sometimes it's conversation with the general partner. If we're buying at the company level, it might be a conversation with some of the founders or the board or early investors. Usually we need permission from the general partner of a fund if we're buying into a fund. Usually we need permission from the company or the board if we're buying a position in the company. There are a few exceptions where we might do something what's called a forward contract. And in that case, we're not really changing the ownership. We're just setting up a contract with the owner of the asset for a portion of the returns when liquidity happens. But in most cases, we're still looking for approval and permission by the venture capitalist who's running the fund or from the founders and board of a company who are running the company. And most of the time we get that.
What are the risks you exiting in the secondary market?
Well, I think, when we're looking at an early stage strategy, we assume most things are going to fail and only a few things are going to succeed. And so that's why we have a very large portfolio approach. When we're looking at later stage and secondaries in particular, we're assuming most things continue working. And so we're looking for assets that are companies that are working and that are growing and that they will continue to grow. And we might be wrong in a few cases there. But again, it's a different shape of portfolio where in the early stage portfolios, we assume 70% are going to fail. 20% will maybe do okay, but really only 5 to 10% will outperform. But those 5 to 10% will do 50 to 100x or more in an IPO. In a later stage portfolio, we're really looking for most of the companies to do 3 to 5x in a 3 to 5 year period. And we might expect that 10 to 20% will fail or will only return capital. We also probably don't expect more than 10% to do 5 to 10x, but we expect a large percentage, 50% or more, that will do 2x, 3x, 5x. And that might be, around 20 to 30% of our portfolio do 2x, do 3x, and do 5x. So those are kind of the outcomes that we look for. So a modest return in a short period of time, or a decent return in maybe 3 to 5 years. But we're still underwriting probably, roughly, I would say, between a 3 to 4x gross and a 2 to 3x net sort of return position, but within a shorter period of time than a traditional VC fund. So it's a more concentrated portfolio. The companies are already doing well, and we're just trying to project that they will continue doing well. And they have a certain time frame. So when we look at those investments in secondary, we're looking at 3 factors. What's the upfront discount that we're getting? And we try and do a good job of underwriting to value to figure out what that real value is, not just where it's priced by the company or the VC fund. And so that discount that we buy to value is an important upfront component. The continuing growth of that portfolio or company over the next 2, 3, 5 years is important. And then some, certainty or confidence in an exit within a 5-year window. So the upfront discount, the growth, and a high probability of exit are the main factors that we look at when we're evaluating either companies or funds.
Are there similar funds like your approach nowadays?
Yes, there are, but not as many of them. And so if you look in the US, well, certainly if we look at private equity, there's a large number of secondary investors in private equity. Most of those operate, at the fund level, and companies like Lexington or Collar Capital, others are raising $10, $20 billion funds. Their individual transactions might be billions of dollars in size. If we look at venture capital secondary, the largest players are companies like Industry Ventures and Stepstone, which acquired a company called Greenspring. They're managing billion-dollar funds, and their typical transaction sizes are probably $30 to $50 million and up. They do a number of different strategies. So they might buy individual company secondary. They might do co-investments alongside existing portfolios. They've actually are primary LPs in a number of small funds. And they will buy out entire funds. Sometimes those are called LP-led or GP-led transactions, where they're buying out a big position or setting up a continuity vehicle for funds that are maybe already 10, 12, 15 years old that are still, continuing. We don't really run into them very much. Again, they're sort of like, the Sequoias of the industry. We're probably more like the smaller vehicles. So we're typically writing $1 to $5 million checks. There's not as many people that are, doing our strategy at that size. In fact, I would say there's very few, at least in the US, and outside the US, there's even fewer. So if you look at the overall VC market, there's thousands of VC firms that do different types of investments. If you look at the secondary market, there's probably not more than 50 to 100 firms that are doing secondary strategies. And if we look at the strategies that we're doing, I would say it's probably less than 10 that are really doing portfolio secondary at the size that we're going after, at least in the geographies where we're.
So back to the first question, beginning of our conversation.
Yeah. Well, we think it's a great time for secondaries. It somewhat works in, contrast to how the rest of the market is. Even in good markets, we still feel like secondaries are a strategy for people who want liquidity or diversification. So it's not like it only works right now, but particularly right now, it's a great time. There are a lot of assets that wouldn't normally be for sale that are for sale, not because the assets themselves are distressed, but because the investors or the founders want liquidity or diversification. So there's a lot of stuff to buy. There's certainly more inventory to buy than there are buyers or capital available to buy. If you look at historically in any downturn, that typically is when the secondary market experiences an expansion. So probably in the 1, 2, 3 years after the downturns, that's when secondary markets tend to expand and increase. And we are seeing a lot of growth in secondary funds, both in size and number, but there's still way more inventory than there is buyers. So it's definitely a buyer's market. The one caution I would say is, those discounts look great when they're upfront discounts, 50, 60, 70%. They're not so great if you're aware that the underlying asset should already be discounted by 30, 40, 50%. And so it's not quite as big as it seems. You have to do the underwriting to figure out what assets are still worth a good bit, and have they not been marked down, or have they been marked down? That's probably where we think we have an edge, just because we've been in venture for 15 years. Both my partner and I have been around the block. We met when we were working together at PayPal 20 years ago. We've made thousands of investments in companies. We've probably invested in 50 or 60 different funds, and we've seen a lot of both success and a lot of failure. So we've had our experiences on both sides of the table there. So we try and be smart about the assets that we're underwriting. And really, again, it's not the discount to what the reported price is. It's the discount to what we think the actual value is that matters. And then it's also still, it's a growth business. We try and predict whether there's going to be growth in the asset. And then we want to see some certainty in the exit. So I always tell people, like, it's probably better to buy an asset at a 10, 20% discount that's growing at 50% per year than to buy an asset at a 50% discount that's only growing at 10 to 20% per year. So that discount maybe counts for 1, maybe 2 years of compounding, but you still want 2, 3, 4 years of real growth and real compounding. And you need that growth if you're going to, bet on them getting to an exit.
What emerging technologies are you most excited about the future?
Well, it's not my job to pick the winning technologies of the future anymore. I think, again, we're betting in things that are already generating revenue and growth. We do reserve a little bit of our capital to bet on other funds and technologies where we're trying to, build pipeline and build relationships. Obviously, AI is a huge focus for everybody. I think it's a little bit overhyped, and in some cases, it's very overhyped. But it's true that it is going to change a lot of not just tech, but even non-tech industries over the next 5 to 10 years. And some of that will happen even faster than 5 years. I think we're seeing quite a bit of change in climate tech investing, alternative energy, different types of green technology. There's a lot of government mandated investment in whatever green might mean to people, but certainly there's a lot of both public and private capital going into climate change. I think life sciences and genetics are a huge area of innovation, particularly as software is starting to come into, doing different types of drug development, disease resolution, and treatment. Also an area where I think we're going to see AI, help with a lot of technologies. Those are all really exciting categories that I think are going to continue to develop. Another one I think is the use of robotics in manufacturing. You can sort of look at, in the same way that AI is a productivity enhancer for a lot of software and digital businesses, robotics can be a productivity enhancer in a lot of physical products and businesses. And there's really a significant amount of attention now coming back to not just bits, but to atoms. So people are contrasting, building in software versus building in physical product. There's additional challenges to building physical products. You have, larger CapEx expenditures. You have cycle time on production and manufacturing. But still, there's a lot of attention to, physical businesses that wasn't maybe as popular 5, 10 years ago is now coming back into popularity. That said, I still think that there's a ton of business to be done in very traditional areas: e-commerce, SaaS, payments, fintech, property tech, jobs and education. So there's a lot of areas that people might think are very played out, but still around the world, those technologies haven't been implemented as much. If you look at places like prop tech, we're probably in an era where people right now are somewhat negative on real estate. Certainly in the US, we're seeing some challenges in commercial real estate. But if you look at how much money is spent on real estate, both commercial and residential, in building properties, in selling and transacting properties, in managing properties, it's a huge percentage of GDP, and it's still very inefficient and not very digital. So we do feel like there's a lot of existing, business models out there that can be benefited from technology. It's not just, AI and genetics and climate tech. And at least for what we're doing, trending, we're investing more in a progression of success, not necessarily in the earliest stages of innovation. So we probably rely on other people to pick, winning technologies and companies, and we're probably betting on the companies that are already winning and the funds that are already winning. I guess I'm a little bit lazier than when I was younger I just try and follow the math and follow the dotted lines that are going in the right direction.
If you go back, what advice would you give your younger yourself?
Well, I think if we're talking about, micro VCs or people starting funds, I think the biggest challenge right now is probably raising capital. It's a very difficult market to raise capital as a first-time VC. Making the investments is probably easier than ever. A lot of people have access to companies. A lot of small checks, can get into companies. And there's a lot of tools and back office platforms for managing your investments. But still, raising capital is probably the biggest challenge. Figuring out your investment thesis, number of companies, size of checks, stage of investment category. I think you still need to figure out where you can, be smart and add value. And whether that's in product or marketing and sales or in people, you have to have some, maybe for some people, that's if you want to stand out from other investors, you're going to try and differentiate yourself. And so that's probably where I would say most of the challenges, trying to be specific and different. So, raising capital is, a necessary condition. You have to be able to raise money to deploy money. But in order to raise money, I think you have to be different from the other players. And usually that means being, specific to a category or a geography, particular method of investing where you're different from the rest of the players. And so as much as raising money is the challenge, what I really try and work on with most other rookie VCs is how do they tell their story so that they're not the same as the next 50, 100 other people doing deep tech or SaaS or AI. Because there's a lot of people raising $10, $20 million SaaS funds or deep tech funds or AI funds, and they all kind of start to blur together.